The stock market plays a crucial role in the economy as it reflects overall economic performance and investor confidence. Stock prices are often used by investors, companies, and policymakers as indicators for decision making, investment planning, and economic evaluation. In general, stock prices are influenced not only by company-specific factors, but also by macroeconomic conditions such as economic growth, inflation, interest rates, and exchange rates. These factors affect corporate earnings, investment costs, and investors' expectations. In emerging markets like Malaysia, stock prices tend to be more sensitive to macroeconomic changes compared to developed markets. This is because emerging economies are more exposed to external shocks, policy changes, and economic uncertainty. Therefore, understanding how macroeconomics variables influence stock prices movements is especially important in the Malaysian context. Why Malaysia? Malaysia is a trade-oriented and developing economy with an active stock market represented by Bursa Malaysia, particularly the FTSE Bursa Malaysia, KLCI. While Malaysia has a relatively stable financial system, its stock market remains vulnerable to both domestic and global economic changes. Recent events, such as the COVID-19 pandemic, global inflation pressures, interest rate adjustments, and exchange rate volatility have significantly affected investors' behavior and market performance. This development highlights the importance of studying stock prices movements in Malaysia using updated data and relevant macroeconomic variables. Past studies have shown that macroeconomic variables plays an important role in influencing stock prices. Variables such as gross domestic product (GDP), inflation rate, interest rates, and exchange rate are commonly used to explain stock market movements. However, findings from previous empirical studies, particularly in Malaysia, are often mixed and inconsistent. Some studies find that certain macroeconomic variables have a significant impact on stock prices, while others report weak or insignificant relationships. In addition, the relationship between macroeconomic variables and stock prices may change over time, especially during periods of economic instability or structural changes. As a result, conclusions drawn from early studies may no longer fully reflect the current economic environment. Despite extensive research on stock price movements, there is still no clear consensus on which macroeconomic factors have the strongest influence on the Malaysian stock market. Many previous studies suffer from limitations such as using short or outdated time periods, examining macroeconomic variables individually rather than collectively, not fully capturing recent economic events and policy changes. This lack of consistent findings creates uncertainty for investors, financial analysts, and policymakers who rely on stock market information for decision making. Without clear empirical evidence, it becomes difficult to develop effective investment strategies and economic policies. Therefore, this study aims to address these gaps by re-examining the relationship between stock prices movements and selected macroeconomic variables in Malaysia using a more comprehensive and outdated approach.
My name is Nur Anatasha Nabila, and now I will be explaining about the research question. To better understand how macroeconomic conditions affect stock price movement in Malaysia, this study is guided by several key research questions. This question focuses on examining the role of GDP, exchange rate, and inflation in influencing stock market performance. The first question is there a significant relationship between gross domestic product and stock price movement in Malaysia? Second, how do exchange rate fluctuation influence stock price movement in Malaysia? Third, what is the impact of inflation on stock price movement in Malaysia? Finally, which macroeconomic indicator, GDP, exchange rate, or inflation exerts the greatest influence on the Malaysian stock market? Next, objectives of this study. The main aim of this study is to analyze the factors that influence stock price movements in Malaysia by focusing on selected macroeconomic variables. Specifically, the study examines the relationship between gross domestic product and stock price movement to determine whether economic growth is significantly reflected in the Malaysia stock market. It also investigates how exchange rate fluctuations affect stock prices, given Malaysia's exposure to international trade and capital flows. In addition, the study evaluates the influence of inflation on stock price movements, as inflation affects purchasing power and real investment returns. Finally, the study seeks to identify which macroeconomic indicator, GDP, exchange rate, or inflation, exerts the most significant influence on the overall movement of the Malaysian stock market. Next, scope and limitation of this study. This study examines the relationship between stock price movements in Malaysia and selected macroeconomic variables, namely gross domestic product, exchange rate, and inflation. Stock prices are represented by the Malaysian Stock Market Index as a proxy for overall market performance. These variables are chosen due to the relevance in explaining stock market behavior in emerging economies like Malaysia, where economic growth and exchange rate stability strongly influence investor confidence. The study uses secondary data from official Malaysian sources and applies quantitative econometric methods to analyze these relationships. However, the study has several limitations. It focuses only on 3 macroeconomic variables and excludes other factors such as interest rates, money supply, political uncertainty, and global economic conditions. The findings are also constrained by the availability and frequency of secondary data, particularly GDP data. Additionally, the relationship between macroeconomic variables and stock prices may differ across economic periods, such as during financial crisis. Finally, the use of aggregate market data may not capture industry or firm-specific differences, and the results mainly reflect statistical relationships rather than causal effect. That's all from me. Thank you.
My name is Nur Izawana Sakila and I will continue the presentation for the third part of our research. This study is important because it helps us to understand how key macroeconomic variables such as GDP, exchange rate, and inflation influence Malaysia's stock price movement. For investor and portfolio manager, our finding can help in forecasting market behavior and managing risk. For policymakers, the result can serve as input for designing more effective macroeconomic and financial policies that promote market stability and sustainable economic growth. From an academic perspective, our research contributes by providing updated empirical evidence using recent data from 2014 to 2024. Earlier Malaysian studies showed inconsistent findings about which macroeconomic variable most strongly influence stock prices. By re-examining this relationship in the context of Malaysia post-pandemic recovery and global economic changes, our study helped fill that research gap. To maintain accuracy, our study clearly defined all variables. Stock price movement is measured using the FTSE Bursa Malaysia KLCI index, which represent the overall market. Macroeconomic indicators include GDP, inflation, interest rate, and exchange rate, also sourced from credible institutions such as Bank Negara Malaysia and the World Bank. This definition ensure consistency and allow future researchers to replicate or compare our results. Our thesis is structured into 5 main chapters. Chapter 1 set the foundation of the research. Chapter 2 reviews theories and past empirical findings. Chapter 3 describe the data and methodology, while Chapter 4 represent our result and interpretation. Finally, Chapter 5 conclude the study and suggest future research direction. In the next section, we move into the literature review. Stock market performance is closely tied to the health of the economy. In Malaysia, as an emerging market, stock price tend to react more strongly to macroeconomic shift. To explain this relationship, we rely on several key financial theories. The first theory is the efficient market hypothesis, introduced by Eugene Fama in 1970. This theory states that stock prices fully reflect all available information, meaning no investor can consistently earn excess return since new information is quickly absorbed by the market. However, in Malaysia, the market might not be perfectly efficient due to slower information flow and investor speculation. That's why stock prices here may respond differently to economic news such as changes in inflation or interest rate. Next, the arbitrage pricing theory, developed by Stephen Ross in 1976, explained that stock returns are influenced by several macroeconomic factors, not just one. APT is very relevant for Malaysia because our economy is open and affected by both domestic and global financial changes. The third theory is the capital asset pricing model by Sharp and Littner. This model links the level of systematic risk measured by the beta to expected return of a stock. It assumes that investors are compensated for taking on market risk but not for risk that can be diversified away. It also helps us to understand the relationship between risk, return, and how broader market conditions influence stock price movement. Lastly, the macroeconomic determinant theory emphasizes that overall economic performance directly affects stock prices. When GDP increases, corporate profits usually rise, which boosts stock prices. On the other hand, higher inflation or interest rate tend to reduce consumer spending and company earning, which can lower stock prices. This theory strongly support our study because Malaysia's stock market is very sensitive to macroeconomic conditions, especially during period of economic instability or policy changes. Next, I'll pass the presentation to the next presenter who will discuss the empirical study that support this theoretical foundation. Thank you.
Moving into Chapter 2, we review the empirical findings that shape our understanding of stock price movement in Malaysia. Our goal here is to bridge the gap between established theories like the efficient market hypothesis and arbitrage pricing theory and the real-world data observed in emerging markets. Starting with GDP, empirical evidence generally show a positive long-run relationship with stock prices. Studies by Lee, Boon and Baharumshah 2001 suggest that sustainable economic growth boosts corporate earnings and investment opportunities. However, this link can weaken in the short term due to market inefficiencies or external shocks, which is why an update analysis is necessary. Next is the inflation rate, which presents a more complex, often negative relationship. High inflation tends to erode real returns and increase uncertainty. In Malaysia, research indicates this effect can be asymmetric. While some shocks significantly impact stock indices, the market often fails to return quickly to a long-run equilibrium. Regarding interest rates, we find a consistent negative correlation. When Bank Negara Malaysia rises, the overnight policy rate (OPR) borrowing costs rise, lowering the current value of future cash flow and depressing stock performance. For the exchange rate, the impact is mixed. While a weaker ringgit may help export-oriented firms, it often raises costs for others, leading to an overall decline in the FBM KLCI. To summarize, while these variables are significant, past findings remain fragmented or inconsistent across different timeframes. Many studies analyze factors individually or focus on limited periods such as the COVID-19 era. Our research filled this gap by examining the GDP, interest, inflation and exchange rates within a single updated framework to determine which indicator most powerfully drive the Malaysian stock market today. Thank you.
Chapter 3 explains how our study is conducted. We outline the data sources, variables, econometric models, and testing procedures used to examine how macroeconomic factors influence stock price movement in Malaysia. This chapter ensures our empirical results are valid and reliable. This study uses secondary data from reliable official sources. Stock price movement is represented by FTSE Bursa Malaysia KLCI, while GDP, interest rate, exchange rate, and inflation rate data are obtained from Bank Negara Malaysia, Department of Statistics Malaysia, and World Bank database. The study period covers from 2014 to 2024 to capture recent economic conditions. The dependent variable is stock price movement. proxyed by FBMKLCI. The independent variables are GDP, interest rate, exchange rate, and inflation rate. All variables are transformed into natural logarithms to reduce variance issues and allow elasticity interpretation in regression analysis. Our research framework assumes that stock price movement is directly influenced by macroeconomic condition. GDP reflects economic growth, interest rate represent monetary policy, exchange rate affects trade and investment, and inflation reflects purchasing power. These relationships are tested using a log linear econometric model. Four hypotheses are developed to test whether each macroeconomic variable significantly affects stock price movement. Before estimation, several diagnostic tests are conducted, including unit root tests for stationarity, pullability tests to determine the appropriate panel model, as well as heteroscedasticity and serial correlation tests to ensure reliable results. The study is apply a statistic panel data approach using pooled OLS, fixed effects, and random effects models. The Hausman test is used to select the most appropriate model. Data analysis is conducted using STATA for panel estimation and eViews for descriptive and preliminary analysis.